So in chapter 4, after we finish our 10 column spreadsheet, which is actually right here, and I only have the last 6 columns, I now am going to be able to prepare my financial statements. And so with this information, I'm going to take and prepare my income statement, my retained earnings, and my balance sheet. Let me enlarge this for you guys, okay? Okay, so this is my income statement. This information I took off of the 10 column worksheet. This is my total revenues. Notice I have them in the right hand column. There is no debit or credits in here, but I have them in the right hand column because there are 2 of them. Notice I have dollar signs here and here. Here are all my expenses. They're always listed highest to lowest, miscellaneous last. I add up my expenses, which equal my total expenses, and subtract from my revenue. So my net income is $71.05. This number goes into the next statement. By the way, guys, these financials we learned about in chapter 1. Here's my beginning retained earnings, add in my net income, subtract my dividends paid out, and I have an increase of $31.05 in my retained earnings. Added to the beginning, which is 0, brings my retained earnings to $31.05. So now I'm going to take this number and bring into my balance sheet. It's going to come down here to retained earnings. So my balance sheet is a little different now. You see I've got some headers. This is called a classification balance sheet. First of all, I now have 3 columns. I had 2 before. This says current assets, total current assets, property, plant, and equipment, total property, plant, and equipment, and current liabilities. So we actually did not have this information on our sheet before. So this is kind of new, and we'll talk about that. Okay, so income statement, basically you're just pulling the information from your spreadsheet, doing the total. The net income goes into the retained earnings statement, and that's going to increase my retained earnings, and that will go into my balance sheet. The balance sheet changes here. It's called a classified balance sheet. And so it's got different headings. Assets are called current assets and property, plant, and equipment, and liabilities are current liabilities and long-term liabilities. So let's talk about the new balance sheet and what to expect. The first thing we're going to start with is current assets. Current assets are things, remember, assets are things you own. Current assets are things that you're going to use up in a year. Here's a list of some of the most popular current assets. Now, we haven't talked about notes receivable. I'm going to talk about that in a minute. Accounts receivable is when a customer owes you money. But let me explain a notes receivable. So we have chapter 8 about this and a whole chapter about notes receivable. But a notes receivable is when a customer owes you money and they can't pay you. They promise to pay you over a period of time with interest and in 90 days, that type of thing. A small, less than a year, promise to pay, but there's interest attached. Usually they pay within 1 year. So a notes receivable is when they actually sign a formal IOU. These are current assets. These are things that you're going to use up in less than a year. So now we have something else that's called property, plant, and equipment. They also use a term called fixed assets or plant assets or long-term assets, things that you will use for more than 1 year. And they are usually your equipment, your machinery, your building. So now I'm going to post these here. And remember we talked about in chapter 3 the book value, which would be the equipment minus the accumulated depreciation. I'm going to show you on the balance sheet, or take a look on the balance sheet, that it shows how the book value looks. Okay, let's move to current liabilities, things you owe. These are things you owe less than 1 year. Notes payable, accounts payable. So all of these are things you would probably pay in less than 1 year. Long-term liabilities are things more than 1 year. And right now, this company does not have any, but a perfect example of a long-term liability could be a mortgage payable. If you were to buy a building for your business and you had to pay over 30 years. But if you do not have any long-term liabilities, you can leave it off of the balance sheet. And then next we have what we call stockholder equity. These are accounts that we normally have, which is retained earnings and capital accounts. So these are the new classified balance sheets and the account names you're going to use. Next, we're going to examine how to close accounts.